All right, welcome back everybody to my new YouTube channel, Invest the Rest, where we're trying to get all additional income, discretionary income, extra savings, any money I can get my hands on and get it into the market, because more time in the market, in my opinion, means more money or more opportunity to make that money work for me. As always, this is not financial advice. I am not a financial advisor, and this is really a discussion on my financial journey in the past and in the future. This video and all of my videos are for entertainment purposes only, and as always, do your own research. Understand what you're investing in before you spend your own money on it. It's very important to make sure you understand what products your money is in. Today, we're going to do a quick growth account update, the $10,000 growth account for 2025 that was started on January 2nd, 2025. We haven't done a growth account update since, I believe, the 9th of January. So it's been quite a while, and there's been quite a few changes in the account. So let me get over to the spreadsheet here, and we'll get right into it. So as I've talked about in many of my videos, it's been a very volatile start to 2025. And I feel that now the growth account is really heading in the right direction. You know, the last update on January 9th, we were at about a 0.6% gain, which was closer to the expectations based on the time frame. But now we're at a staggering 1.88%, 2.5 weeks, I'll call it, into January, with really almost 2 full weeks, 2 full trading weeks to go. And so as the thumbnail would indicate, if this keeps going in this direction, we're going to be close to a 4% gain, 3.5% gain in the first month of 2025 with the portfolio that we've chosen. So as you can see, right, the percent return column for this account, before I cover that, obviously $9,907 was invested on January 2nd in the funds that you see in column C. The return column, everything as of close of market on Friday is in the positive, ranging from 0.67% gains to an excellent 3.8% gains. Total, based on the profit loss that we're seeing, $185, really $186 versus the $9,907 that we invested. We're looking at a 1.88% gain. Again, 2.5, round up to 3 weeks into the new year, into 2025. So very happy with this progress so far. One of the updates I did, we did take a major dip. We were down quite a bit. I think the losses were up in the $100 or $200 range midway through that first week, but the account has rebounded. The market has started going in the right direction, and we're seeing the gains that we wanted to see, that I expected to see based on the funds that I picked. So if you look at the front runners, right? Let's take a look at the front runners. You have two John Hancock, JHSC and JHMM, both funds right up near the 3.8%, 3.7% return mark. And then you have the Fidelity inflation-based funds, FCPI, which is up near 3.52%. So what I thought I'd do today, since the growth account updates, they're pretty quick, right? This is the most passive account that I have. Basically, let it sit, let it grow, and hopefully we can reach that 37.33% ROI that was achieved by this portfolio based on data on the funds, right? This is the hypothetical return on investment that was achieved in 2024, or I should say that we're trying to achieve in 2025. But based on data, this is what was achieved in 2024. And I'm hoping to hit that in 2025. I mean, honestly, if we got above 30%, I think that would be fantastic gains. You can't really balk at a passive account with a moderate to low amount of risk, in my opinion, making 30% on your money. I mean, that's excellent. I can't complain about that. But what I thought I'd do is review the front runners, and specifically JHSC, the front runner for John Hancock, And then the front runner, put it up against the front runner for Fidelity, FCPI, which is at 3.52%. So let's get into the comparison here. I pulled a, similar to my other growth account fund comparisons, I pulled some data from Fidelity and Charles Schwab, which are the two main brokerages that I use for my trading accounts. And on the screen, we have JHSC. We look at the last year of performance. You know, really 2024 is where this fund saw significant growth. Obviously in the beginning of 2025, over here on the right, it did see that year beginning dip that most of the market experienced, and now it's on the recovery track, right? So we went down as low, looks about, you know, just right around the $39 mark, and now we're headed towards the $42 mark. Hopefully it'll reach that next week. I didn't pull the current price. Let's take a look up here. So JHSC is at $41.34 as of market close, and obviously, like I said, headed to 42 and beyond. The portfolio makeup, if you look, they have a lot of their holdings are in industrials, in financials, right? 20% each. They're also in information technology and consumer discretionary, right around that 13% mark each. And then you have healthcare at 10%. And then a wide range of diversity in some lower volatility sectors, in my opinion. You have energy at 5%, materials at basically 5%, 4.86%, real estate at 4.41%, utilities 2.6%, and then communication services and consumer staples right just over that 2% mark. So quite a different makeup than the previous funds that we've taken a look at. Again, you know, I think this may have helped them in the market trends at the beginning of 2025. In my opinion, they're a little bit more diversified, and they have some sectors that are a little bit more resistant to dips in the market. Going down here to their holdings, I always like to take a look at the top 10 holdings of a portfolio or of a new fund. And what you'll notice here is that the holdings of this fund are drastically different than the Apple, the Googles, the Nvidia, the Teslas that we saw in some of the other Fidelity funds. They have CRDO, which is Credo Technology Group, Bath and Body Works. You see Trex Co. Inc. But again, if you look at the percent of net assets, I think it's interesting that it's 1.01% is their top percent of net assets, right? And it goes from 1% all the way down to 0.69%. And 7.64% of the portfolio is in the top 10 holdings. Now, if you go back to my last growth account update video, you'll notice that some of the Fidelity funds, if I scroll back up here to the table, FBCG, ONEQ, and FDLO, which I reviewed at my last growth video, their top 10 holdings retains quite a bit higher of a percentage in relation to the rest of the portfolio. So I think 7.64% for the top 10 holdings is kind of low, in my opinion. And then if you look over here, you can see obviously CRDO, sub-industry, semiconductors, they're up 19.06%. Again, GTLS, Chart Industries, sub-industry, industrial machinery and supplies and components, they're up almost 12.5%. Oil and gas exploration and production, up 13.3%. And then ITCI, intracellular therapies, pharmaceutical sub-industry, 51.1%. So not too much red on this chart here. And, I think that's a good thing. I think this, based on what they're invested in, I think this fund is positioned well to do fairly good in 2025. So that is JHSC. If we scroll down here, let's take a look at FCPI. Okay, this is the Fidelity account. This is the Fidelity front runner currently in my portfolio. A little bit more consistent of a trend over the past year, okay? A little bit more of a consistent, smooth move towards the positive. Again, experiencing that dip in the beginning of 2025 on the right here, and then also starting to recover and move towards the upside. A little bit more, maybe even a little bit more diversified in a different way on the portfolio makeup. You know, information technology at almost 27%. Again, we see that a lot in the Fidelity funds in this portfolio. The other three funds that I mentioned in my previous video also had a very large holding in information technology. Healthcare and consumer staples, a little bit higher, 13.72% and basically 10.5% in FCPI. Financials, 9%, energy, 8%, materials and utilities, right around 6.5%. Real estate and consumer discretionary, a little bit just above 5%, and then industrials and communication services at 4.19% and 3.85%. So looking at that portfolio here, right, energy specifically sticks out to me, 8.22%. We scroll up to JHSC, and their energy is only at 5%. Again, consumer staples for JHSC, 2%. Scroll down here to the Fidelity account, FCPI, or fund, I should say. Consumer staples is at almost 11%. So quite a bit of a different makeup in the diversification of these funds. Taking a look at the holdings, well, there it is. Like I said, among many of the Fidelity accounts that are in my portfolio currently, the top 10 assets, right? You have NVIDIA, Apple, Microsoft, all the big players, and they make up a significant portion of the overall portfolio. Again, you have your sub-industries over here. I think a lot of these sub-industries are fairly consistent. You still have your oil and gas exploration and production. You still have your semiconductors, oil and gas storage and transportation, almost up 9%. Electric utilities up 18%, which is an industry that I wouldn't typically associate with large growth, but it's been doing well so far year to date. And so, I think what you didn't see up above, maybe system software, some of the hardware storage and peripherals and technology, that's really this fund's biggest loser. I think if that negative 8.85% year to date, Apple's been down, that other players in that industry have been down. This fund might be the front runner if it weren't for those losses. You have Vistra Corp, Texas Pacific, NRG Energy, again, electric utilities being up 17.5%. And then, again, Amazon, got to have Amazon in a Fidelity account. It seems like that's across many of their portfolios. But the stark difference here, right? FCPI, their top 10 holdings make up 35.26% of their portfolio. So these top 10 holdings make up 35.26% of the portfolio. That's contrasted by JHSC, right? The John Hancock competitor currently only makes up 7.64%. The top 10 holdings only make up 7.64% of the overall fund, the overall holdings. So quite a difference there. Now, again, I don't want to come across as trying to present these as similar funds. These funds have different strategies. They have, they were designed differently. They were designed to excel in different markets. They were designed to resist different down markets. And so obviously the makeup is going to be different. The reason I'm comparing them against each other is because they're currently in 2025 the two front runners in my account, right? JHSC is up 3.8% and Fidelity is up 3.52%. Obviously we got this JHMM here, but I wanted to compare John Hancock to Fidelity. So they're the front runners right now, and I based on the difference in how these funds were designed and what their goals and strategies are, I thought it was interesting that going into the third week here, 2025, that those two funds were the front runners. You can see here on the table many of the funds very similar performance, right? Especially those top 3 Fidelity funds, all right around the same mark. Down here, you got a Vanguard fund, you have an iShares fund. They're all performing very similarly, which is important, right? Because that's why I diversify my portfolios. And if any one of these funds, any one of these strategies were to fail, the rest of the portfolio would make up the difference. So $185, $186 so far, 1.88% return on investment, and we're not even out of January yet, and that's on an initial investment of $10,000. Let me know what you liked about this video. Share your thoughts and your comments down below. Like if you found any of this information valuable, entertaining, and subscribe. I'm going to continue to update consistently throughout the year of 2025. Subscribe to the channel, be notified, and let's start a discussion with everybody else and talk about finances, right? Because the more we talk about it, the more informed we can all be. So as always, everyone, thanks for watching, and I'll catch you on the next one.